The Federal Reserve faces a difficult challenge. The U.S. economy is sending mixed signals. Inflation remains stubbornly high, although it has moderated somewhat. The job market, however, is still strong. This complicates the Fed's decision-making regarding interest rates. Raising rates could cool inflation, but might also trigger a recession. Lowering rates too soon could reignite inflation, undoing their hard work. The Fed is walking a tightrope, trying to balance these competing forces. The Fed's primary tools for influencing the economy are interest rates. By raising rates, the Fed makes borrowing more expensive. This can slow down economic activity and curb inflation. Conversely, lowering rates makes borrowing cheaper, encouraging spending and investment. This can stimulate the economy but might also lead to inflation if not managed carefully. The Fed must carefully weigh these factors when deciding its next move. The current economic climate is marked by uncertainty. The war in Ukraine, supply chain disruptions, and the ongoing effects of the pandemic continue to create volatility. This makes the Fed's job even more challenging. Predicting the future trajectory of the economy is difficult in these uncertain times. The Fed must rely on its expertise and available data to make informed decisions. The Fed's decision to hold rates steady in 2024 is a gamble. It assumes that inflation will continue to moderate without additional rate hikes. This approach relies on the lagged effects of previous rate increases to further slow inflation. The Fed is betting that the economy can handle the current rates and that inflation will fall without drastic measures. The April PCE inflation report, a key measure for the Fed, showed a slight uptick. This indicates that the fight against inflation is not over. The Fed is closely monitoring this and other economic indicators. They are trying to determine if this uptick is a temporary blip or a sign of persistent inflation. The Fed will likely maintain its cautious approach until there is clear evidence that inflation is under control. Holding rates steady for an extended period is not without risks. If inflation proves stickier than anticipated, the Fed might be forced to raise rates more aggressively later. This could lead to a sharper economic slowdown. On the other hand, if the economy slows too much, the Fed might be caught with limited options to stimulate growth. This delicate balance highlights the challenges of monetary policy in uncertain times. The Federal Reserve is laser-focused on one number above all else: core PCE. This measure of inflation, which excludes volatile food and energy prices, is the Fed's preferred gauge. They believe it provides a clearer picture of underlying inflationary pressures. The Fed watches core PCE closely for signs of sustained price increases. Core PCE matters because it influences the Fed's policy decisions. A significant rise in core PCE could push the Fed to raise interest rates. This is intended to cool the economy and bring inflation under control. Conversely, if core PCE remains subdued, the Fed may be more inclined to keep rates steady or even lower them. The Fed's focus on core PCE has drawn criticism from some quarters. Critics argue that it doesn't fully capture the pain consumers feel from rising food and energy costs. They contend that the Fed should consider a broader range of inflation measures. However, the Fed maintains that core PCE is the most reliable indicator of underlying inflation trends. Section 4. Reading the economic tea leaves, jobs, inflation, and the Fed's crystal ball. The Federal Reserve faces a complex economic puzzle. It must decipher a range of indicators to make informed decisions about interest rates. Two key pieces of this puzzle are job growth and inflation. The Fed closely monitors both to assess the overall health of the economy. Robust job growth typically suggests a strong economy. This can contribute to inflation as businesses raise prices and wages increase. However, weak job growth can be a sign of economic trouble. The Fed aims to strike a balance, fostering a healthy job market without triggering excessive inflation. The Fed's next move will depend on how the economic picture evolves. If inflation continues to moderate and the job market remains strong, the Fed may hold rates steady. However, if inflation heats up or the job market weakens significantly, the Fed may adjust course. The Fed's decisions will have ripple effects throughout the economy, impacting borrowing costs, investment decisions, and consumer spending. Section 5. Investors' Playbook: Charting a Course Through Fed Uncertainty. The Federal Reserve's interest rate decisions have significant implications for investors. Understanding the potential impact of these decisions is crucial for making informed investment choices. Investors must navigate a complex landscape of economic data and policy pronouncements. When the Fed raises rates, it typically makes bonds more attractive. Higher interest rates can translate into higher yields for bondholders. Conversely, stocks may become less appealing as borrowing costs rise for companies. This can impact corporate profits and investor sentiment. Investors should stay informed about the Fed's policy pronouncements and their potential impact on different asset classes. Diversification remains crucial in navigating market volatility. It's also important to remember that past performance is not indicative of future results. Investment decisions should align with individual financial goals and risk tolerance. Seeking advice from a financial advisor can provide personalized guidance in navigating these uncertain times.